when you realize in a bank, you don't actually own your money. And people are now realizing that. And the Treasury and the Fed are like, well, we'll just pretend that it's okay. That drives people into this parallel financial system. I got into Bitcoin in 2013 for exactly this reason and have been an active participant of the market ever since. And so I think what Balaji is saying is, listen, guys, here's the life raft. You can take it. Now, Bitcoin's relationship with the Fed balance sheet is really interesting because it goes up exponentially. So if I look at it versus M2 year on year or the Fed balance sheet year on year, it massively outperforms in the bull markets and then pulls back when the liquidity comes out of the system again, but it keeps going up. So yes, I think there is a potential setup here for Bitcoin and the whole crypto market actually to be shockingly strong, more like 2013 than 2019. 2019, we had that big correction, and that was partly due to this G5 central bank balance sheets. Some of them were contracting over that period of time, and it pulled back the crypto market. This time around, I don't think we're going to see that. I think we're going to see all of the central banks falling into place because there's banking issues both in Europe and the US, and China has its own issues. So that they've all got the same issue, which is debt. They're all going to have to stimulate. So I think it's more likely to play out like 2013, which is very squeezy, then sideways consolidation, then very squeezy. Every time we go through these cycles, more and more people understand what the benefit is of Bitcoin. And now we've got 300 million people that have used Bitcoin and other crypto. The next time around, it'll be 1 billion people or 600 million people or whatever the number is. And those people will have been awoken to the fact that there is another way out of this. Now, the issue is, as we all know, is Bitcoin is extremely volatile. So it's very hard to think of it in terms of, well, it's a wealth preservation asset because people's time horizon is too short. But if you hold it long enough, it does extremely well. It does better than the Fed balance sheet, better than any other asset in existence. But people get freaked out by the up and down move. But if they just zoomed out, they see it does a phenomenal.
Fed raising rates again, banks collapsing in the US and Europe, inflation is rising, and an awful recession is starting to form. Knowing all these, investors are moving away from traditional markets to digital opportunities like Bitcoin. And most people don't even seem to see what's coming next. As a result, these will likely be some of the retail investors' most profitable moments in history. To help you understand that, we will have Raoul Pal, co-founder and CEO of Raoul Vision and Raoul Vision Crypto, explain how we got to this turbo crisis and how crypto and Bitcoin will create so many new millionaires from here on. First, let's understand how did we get here and why everything is falling apart.
My view on all of this is that 2020, obviously the world had shut down. I remember you and I speaking just before it happened. And what happened is the global economy stopped entirely. And to stimulate it, as everybody was at home, they both undertook massive amounts of quantitative easing, but also they did something different, which was fiscal stimulus, direct handouts. So as we started pulling through the business cycle, as the world started reopening, then the inflation genie that comes from fiscal stimulus, which is very common, not from monetary stimulus, we'll come on to that later, that started appearing in the global economy, and the central banks started to hike rates. They started late. They didn't think it was going to come as big as it was. Then Russia invaded Ukraine, and obviously all commodity prices go through the roof. Supply chains get shattered, and that exacerbated the existing supply chains because people weren't back in the workforce, all of that stuff. Factories weren't ready. So we start with this big inflationary pressure. So the Federal Reserve then decide to hike rates at the fastest rate of change in all recorded history. And eventually that tends to lead to the kind of negative side of the business cycle. So that starts playing out. The forward-looking indicators start falling, suggesting we're going to go into recession, which everyone's been talking about. And a lot of people have been saying, well, what's going to break? If you raise rates this much, something's going to break. And eventually it was the banking system. And it's all a story, as ever, of too much leverage. It's coming out that, obviously the Fed kind of knew that the regional banks weren't great. We also know the pension system's a problem. We also know there's a number of things that can be a problem in this system when you've got a globally indebted situation like we've got today. The world has never been this far in debt, and no country in world history has ever been as far in debt as the US is as a percent of GDP. So it's problematic, but that's just a function of the business cycle. Okay, it's actually really simple. So there's two levels for what a bank is. It is the deposits that they have, that's what makes them a bank, and then it's what they do with the deposits, they invest them. So in a normal course of events, banks make business by something called the steep yield curve. So they borrow at, let's say, 2% interest rates, i.e. they pay you 2% on your deposit, and they lend it out into the market at 5%. That's the yield curve. So that's a longer term duration that they take the risk on. The issue is the yield curve got massively negative. In fact, the second most negative yield curve since 1980. So that means that the banks ordinarily would have to pay you 5% or 4% interest on your deposit, but then they invest it in the bond market in 20-year bonds or 10-year bonds or 30-year bonds, and they're actually getting less money. So they're losing money every day. So what they did is artificially change the yield curve. So they said, well, we're actually going to give you 0.5% interest on your money, and then we can lend it out in the bond market at something different, at a higher rate. So they've manufactured a steeper yield curve. The issue is people have the freedom to move their deposits. So they can move their deposits out of this 0.5% world into a 5% world of CDs, Treasury direct money market funds. So people are incentivized to move their deposits because the rate of interest is actually the highest we've seen for a long time. So people are incentivized to do that. That means deposits shrink from the system. As they shrink, you have to unwind the bets that you had at the long end, the longer maturity bets. Now, the problem is those are all underwater because the Fed raised rates so much. So then they've got losses, mark-to-market losses. But to collapse the deposit base, you have to realize those losses. Normally, you can just leave them on your book as mark-to-market accounting. You don't need to worry about it. But in this case, you have to do something about it. Suddenly, poof, they're all got no money.
If banks are using users' funds to make bad bets and collapsing to liquidity issues and the Federal Reserve rates increase, are they similar to FTX and Sam Bankman?
There's a key, the mechanism is the same, but there's a key difference. FTX is a brokerage. They're supposed to keep customer deposits separate, and they don't have a right to use yours. A bank is in the business of using your deposit to make bets. And back in 2020, the Treasury changed the rules and said you don't need mark-to-market accounting because the bond market had become illiquid. And that was okay, but it compounds this issue once depositors leave. So yes, there is a comparison that you took customer money and you made a bet. One is actually allowed, the other one's not allowed. There's also a lot of regulation about what kind of bets you can take. We stopped the ability to have prop trading in banks. That went by the wayside a while ago. But FTX was essentially prop trading with customer money, which they shouldn't have done, which was kind of more what MF Global did when John Corzine essentially took brokerage deposits and bet it on the European bond market and blew up. And he shouldn't have done that. He was allowed to do it at Goldman, but it's a different business. Brokerage, you don't get the rights to use the customer funds. In a bank, people don't realize is you are the product. And that's very different.
How does Bitcoin get to be the winner of all this mess, and why is it pumping right now?
Generally speaking, over time, the observable relationship, because it's a 97.5% correlation between the G5 central bank balance sheets and the S&P 500, is every time it grows by 1% or shrinks by 1%, the equity market moves by 2%. So we've got a clear relationship. And so, I don't know, we just increased the balance sheet by whatever it was, 5%, let's say. So therefore, equity markets go up 10%. That's roughly how it works. However, NASDAQ goes up at a multiplier of about 1.4 times the S&P because it's got a technological uptrend and it's probably accelerating as AI, robotics, and all of these things come in. And crypto's got a much bigger multiplier. So let's go back to the last time we saw this, which was December 21st, 2018. The Fed just stopped and said, right, we're not going to increase the balance sheet. We're not going to raise rates any further. Not going to decrease the balance sheet. Not going to raise rates any further. Over the next 6 months, crypto was up 300%. So Bitcoin did 300 and something percent. The exponential age stocks, which are the really kind of growthy ARK style stocks, they were up about 30%. The NASDAQ was about 22%, something of that magnitude. The S&P was about 15%. And so we can see that relationship happens. Assets will go up according to the balance sheet. I think the balance sheet goes up significantly, 30% plus over time. Therefore, the equity market can go up 60% in the S&P, maybe more. So new all-time highs in the next 12 months or so, maybe a bit longer. NASDAQ gets there sooner because of its relationship. Crypto moves very fast. I got into Bitcoin in 2013 because I lived the European banking crisis and obviously the financial crisis. But the European banking crisis was very similar to what's happening now. The local bank in the village that I went in went under and took everybody's deposits. They bailed them in. We had a run on deposits, liquidity issues. They were invested in things that were illiquid, which was real estate. Real estate market had come under pressure. Very, very similar. Too many small banks in Europe. And so Draghi backstopped the whole lot.
When Raoul Pal got into Bitcoin in 2013, this was the reason.
And I realized that there was no trust in the financial system. Nobody knew who owned what when Lehman went under. And they were terrified of others going under because of the same issue, because the daisy chains of collateral are everywhere in this market. And then when you realize in a bank, you don't actually own your money. And people are now realizing that. And the Treasury and the Fed are like, well, we'll just pretend that it's okay. That drives people into this parallel financial system. I got into Bitcoin in 2013 for exactly this reason and have been an active participant of the market ever since. And so I think what Balaji is saying is, listen, guys, here's the life raft. You can take it. Now, Bitcoin's relationship with the Fed balance sheet is really interesting because it goes up exponentially. So if I look at it versus M2 year on year or the Fed balance sheet year on year, it massively outperforms in the bull market and then pulls back when the liquidity comes out of the system again, but it keeps going up. So yes, I think there is a potential setup here for Bitcoin and the whole crypto market actually to be shockingly strong, more like 2013 than 2019. 2019, we had that big correction, and that was partly due to this G5 central bank balance sheets. Some of them were contracting over that period of time, and it pulled back the crypto market. This time around, I don't think we're going to see that. I think we're going to see all of the central banks falling into place because there's banking issues both in Europe and the US, and China has its own issues. So that they've all got the same issue, which is debt. They're all going to have to stimulate. So I think it's more likely to play out like 2013, which is very squeezy, then sideways consolidation, then very squeezy. You know, every time we go through these cycles, more and more people understand what the benefit is of Bitcoin. And now we've got 300 million people that have used Bitcoin and other crypto. The next time around, it'll be 1 billion people or 600 million people or whatever the number is. And those people will have been awoken to the fact that there is another way out of this. Now, the issue is, as we all know, is Bitcoin is extremely volatile. So it's very hard to think of it in terms of, well, it's a wealth preservation asset because people's time horizon is too short. But if you hold it long enough, it does extremely well. It does better than the Fed balance sheet, better than any other asset in existence. But people get freaked out by the up and down move. But if they just zoomed out, they see it does a phenomenal job at opting out of the financial system over time.
How will the government act upon Bitcoin? Is the US supporting and integrating it into its economy? Or is it doing the opposite and screwing things up for people, ending up losing the digital currency war to other countries? What are Raoul Pal's thoughts on this?
So if we go back to our conversation earlier about bank runs, and we said, you either kind of guarantee the system or you try and throttle it. My view is the US understands crypto, understands that it is the answer to the future, but they need to throttle it because if you create the bank run on the entire system, then the unintended consequences are simply gigantic. That's kind of everybody losing their jobs, the entire system breaking apart, the entire system of the United States as being the world leader, or Europe, and all of this falls apart. They don't want that. But I think they understand that there is a future here, but there's a battle to get people across because some people can't stand it. They don't like the idea of it. Other people understand it, but don't want it to happen too fast. And I get that. So I think that there will be an ongoing war. And if Balaji gets across what he wants to do, which is get more people to move out of the system into the Bitcoin market, we'll see the pushback coming. But it happens very quickly because the mob is pretty fast, as we know. And the mob with a hive mind who's deciding, let's go to the parallel financial system, they can move really fast. So the government's going to try and stop it. But, they do have, as Punk 6529 talks about, there is a freedom to transact here. You need the ability to do that. And if they go against that, then they're really trying to change the political spectrum entirely. And I think that the pushback would be so gigantic, but it is going to be a fight. But within this fight is a bigger world. The US has been down this route before. It tends to get self-protectory at various points, but the UK is looking like it wants to regulate crypto in a very sensible way. They understand regulatory arbitrage better than any country on earth. You see, once the US screws up and misses an opportunity, the UK has the rule of law, the language, the ability for Americans to go and live and work there. It's a global capital center. It's connected with Singapore, the Cayman Islands, Hong Kong, the UAE, all of the places that matter. It has a broader relationship on a less aggressive policy. So my guess is we don't know whether this government will last in the UK or not. But if it does, the UK will probably eat the US's lunch. And we'll see Coinbase, we'll see Kraken, we'll see Circle, we'll see everybody relocating to the UK because it's an easy change to have. And don't forget, this is $1 trillion industry. It's $3 trillion at peak. What's it going to be at next peak? 5, 10 trillion, probably. So of course the UK wants it because it's lost relevancy. So the US has to be very careful what it does here. I don't think it stops the people per se getting involved. I think it tries to regulate that. That's all well and good. I think it's trying to stop the infrastructure layer being built and becoming too powerful, too decentralized. So they can regulate Coinbase and maybe they can regulate Circle, but they don't want too many moving parts in all of this. But if that's the case, if they're too heavy-handed, in a global world, that capital's going to flow elsewhere.
Are you enjoying this interview? Hold on, there's a lot more good content incoming. What is Raoul Pal's portfolio now? What are his recommendations?
So at a top-level macro position, I haven't cashed out of a single penny of crypto, and all I've done is use the cycle when the liquidity cycle hits the long-term uptrend that started happening in June of last year to just add to my positions. That's all I've done. Now, there are some trading opportunities around like bonds, because I think bond yields go from 4% to 1.5%. So can you make money? Will you make more money in crypto? For sure. But people don't want the risk, and people are such dicks online about the kind of risk you have to run to do it, that yes, there's traditional answers. You could buy gold, you can buy bonds, you can probably buy technology stocks, or you can buy crypto. And you skin the cat any way you want it in terms of what risk profile. And I've talked about my risk profile is, I have income, I have assets that are paid for, so I can take more risk with the liquidity that I have. I don't do VC because I don't like a 13-year payout. I like to be in control. I'm a hedge fund guy at heart, so I like to be in control of my liquidity. And so I haven't changed anything at all in terms of my asset allocation apart from increasing it. and using the leverage. So I first bought Bitcoin at $200 in 2013. It went straight up to $1,000. And I'm like, I'm clearly George Soros. I'm the best investor the world's ever seen. 500% in 3 months. I'm a genius. It then falls 87%. And my time horizon was like 5 years plus. So I'm like, well, probably 10 years. Because I wrote that first ever macroeconomic strategy paper about Bitcoin in 2013. So I said, okay, fine. So it's a call option. I'll let it go up and down. So it fell, didn't do anything, watched it. It rose 2017. I got confused over the staking wars, the forking wars, and I'm like, I don't know what's going on here. I'm going to take my money out. And I sold out at something like $2,000. So I've made 10 times my money, one of the best bets I'd ever made, and watched it. Now, I'm still interested in crypto, but I thought it was in a bubble, and it was. It shot up 10x more to 20,000, then collapsed 85% or 82%, whatever it did that time around. And then I bought it again really well in kind of April 2020 when it fell into the middle of the wedge pattern. I bought it right at the right level. I didn't get the absolute low, but let's say I got in about 6,500, and then I put in a much bigger bet than I did first time around, and great. So I went back recently and looked at it and thought, what happens if I just kept my original $200 in its original size? Because it looked like I traded it really well. I bought it here, I sold it here, and then bought it there. Problem is the heres and theirs were all higher because I sold at 2,000 and bought back in at 6.5. I fucked the whole thing up. Really, if I just held it, I'd have made 5 times as much money. And then the real magic unfolded is if I'd used the liquidity cycles and bought them every time we've had that kind of M2 fall down, M2 growth fall down, global M2 growth, bringing it back to the long-term uptrend. Had you just bought then, i.e. the crypto winters, even if you just missed the low by 30%, maybe more, I still would have done over 20 times better. Even accounting for the fact I put a lot more in April 2020. So I've learned, many of us are having to learn how to trade a exponential asset that's in a logarithmic uptrend that is cyclical. But that's how I just deal with it now. I just use that simple framework. Is the adoption going on? And where are we in the liquidity cycle? And just use that.
Let's close with this question. What is Raoul Pal's Bitcoin price prediction?
My general thesis is the market's going to be squeezier than people expect. So I think we probably get to 50,000 faster than most people expect. When that is it this year? Is it within 12 months? Probably. Don't know. And over time, we just keep the adoption curve and it keeps going. So, where does it go at the peak of this cycle? I don't know. Again, I don't want to be hung by dicks online for all of this, but, over time, does it take out 100,000? Does it take it 250,000? Of course it does. It's just a matter of when. And the timing part is the red herring. If you've got a long enough time horizon and the trend rate of adoption and the rise in the price of the asset over time beats all other assets, you're under no motivation to do anything else but hold.
Want to see more curated daily crypto content like this to help you protect your wealth while profiting from these crazy times? Please leave a like and subscribe. We do our best to bring you quick to consume value with daily uploads like this. Thank you so much for watching. See you tomorrow.